Hello, my name is Clive Corcoran and welcome to my YouTube channel, The Corcoran Codex. If you are a returning visitor, then welcome back, and if you are a first-time visitor, then welcome, and I hope you will decide to subscribe to the channel where I look at big ideas and episodes in the world of global finance. I try to explain them in relatively easy to understand ways. And in this particular video, I'm going to look at some major rogue trading incidents that have happened in the world of banking. Let me begin then with this one on the screen now. This one occurred back in February of 1995 and led to the collapse of a well-known prestigious UK bank by the name of Barings Bank. You can see here the headline from the UK newspaper, The Guardian: fraud brought down Barings. This gentleman here was at the time the governor of the Bank of England, Eddie George. He said there must have been collusion between the trader and staff. You can see here from the Financial Times, Barings forced to cease trading. And it all involved this gentleman here by the name of Nick Leeson. There he is again. And he actually was featured in this book, Rogue Trader, which he authored, How I Brought Down Barings Bank and Shook the Financial World. So let's go through a timeline, if you like, of how the bank collapsed and what happened. Leeson took charge of not only the front office at Barings branch in Singapore, but also the back office. Right there, we have a fundamental breach of sound, prudent operating procedures. This enabled him to hide losses and unauthorized trading using a trading account which he had established, which was the 5/8 account, 8888 account. Despite enormous losses accumulated in that account, Leeson continued to bet heavily on the Nikkei index, the Japanese stock index, during the course of 1994. Now, what really caused the huge problem, which led to the collapse of Barings, was that the Nikkei plunged after an earthquake hit the city of Kobe in Japan on January 17th, 1995. As I recall, this was a magnitude 7 or 8 earthquake, very substantial, which led to very serious damage to the city of Kobe and also brought about a financial crash in the Nikkei index. The total losses at the time amounted to 2.2 billion Singapore dollars, over £1 billion at the time, and this brought about the collapse of Barings Bank in February 1995. Leeson pleaded guilty to charges of fraud and forgery, was sentenced to 6.5 years in prison in Singapore, but only served 3.5 years of his sentence. I might just mention that right up to date in 2026, Mr. Leeson now lives in Ireland, where he has become quite a successful businessman. Let us look at another example here. This article comes from the Wall Street Journal in February 2002. Allied Irish banks say a rogue trader lost $750 million in unauthorized deals. So we can read a little bit from this article. The bank said a rogue trader at its US unit incurred losses of this $750 million through unauthorized trading. Allied said that this gentleman, John Rusnak, an FX dealer at the Baltimore headquarters of the bank, allegedly tried to disguise huge losses through fictitious foreign exchange trades from early 2001 through last month. Bank officials said they were stunned by the scale of the loss. I find it very difficult to see how that much money can be lost in foreign exchange, said one executive. If you gave me a license in a year to do it, I would struggle to lose that much money. You'd need a whole trading room to do it. Allied, which said it believed there was both internal and external collusion, saw its shares drop 17% on the news. company, which is based in Dublin, said the trading losses will result in a charge of 517 million for 2001, with its loss of about 2 billion euros in market cap Wednesday. Allied at least temporarily lost its perch as Ireland's largest bank by market size. Let's turn to another. In fact, I think this might well qualify as the largest loss resulting from rogue trading. This involves Societe Generale, a very well-known French bank. And let me first of all have a look at this article here from the Wall Street Journal. This is as of January 25th, 08. So the bank announced that it had lost $7.2 billion, not because of complex subprime loans. Bear in mind, of course, we're going back into the period of leading up to the financial crisis when a lot of news coverage was about subprime loans, but the old-fashioned way, because a 31-year-old rogue trader made bad bets on stocks and then, in trying to cover up, dug himself deeper into a hole. So this involved this gentleman here, Jérôme Cavil, as it says here. He managed to evade multiple layers of computer controls and audits for as long as a year, stacking up 4.9 billion euros in losses for the bank. So at that time, this amount, close to 5 billion euros, was equivalent to $7.2 billion. Unlike many of his high-level trading colleagues, Mr. Cavil graduated not from one of France's elite universities, but from a business college in Lyon, worked up the ranks. It was from his perch in the department that deals with auditing the bank's trading that Mr. Cavil developed what a bank official described as an intimate and perverse knowledge that he used to cover up the unauthorized trades. This is the largest single rogue trading loss in history. Now, Cavil had intimate first-hand knowledge of all the back office systems. He was, as I just mentioned from the article on the right there from the Wall Street Journal, he was initially hired in the IT function and knew his way around all of the back office systems. And within the bank in Paris, there were poor internal audit systems that failed to detect fraud for more than 1 year. Some of the key lessons to be learned: regular changes of security protocols, even just basic like changing passwords on a regular basis. And I'll come back to a little personal anecdote about this in a moment. What is also required is separation of traders entirely from any back office surveillance systems. We can see much later now in 2018, there again is Mr. Cavil, Monsieur Cavil, and he lost 5.6 billion trading. Well, it doesn't quite jive with the number we saw on the Wall Street Journal article, but nonetheless, Paris judges overturned a $520,000 unfair dismissal award that he had won 2 years prior, after the court rejected the notion that SocGen knew that the convicted trader had been amassing gigantic positions that caused the bank the 4.9 billion euro loss. That does equate to the number from the WSJ article. Wednesday's verdict comes just a few months after Cavil lost a last-ditch effort to get a retrial and blame SocGen for the massive trading loss he was found guilty of causing at the bank more than a decade ago. The 41-year-old maintains that his superiors looked the other way as long as he was making money for the bank. I'll just share a personal anecdote here. Some years ago, when I was trading a group of traders who worked for a French bank in London, one of the participants in that group had been a contemporary and had worked alongside Jérôme Cavil at the SocGen office in Paris. And one of the things that he mentioned, which is quite staggering, was that the bank had not changed passwords after Cavil left his back office duties and then became a trader. I mean, quite extraordinary lack of prudential risk management on the part of the bank, where, for example, passwords were not being changed on a regular basis. Let me give you one more example. This one involves UBS, which was fined for lax controls of a rogue trader. UBS was fined $47.5 million for being heedless enough to let a rogue trader lose $2.3 billion for fraud by his abuse of position and false accounting charges. Adeboli received a 7-year sentence, served less than half of that term in prison in the UK, and in 2018 he was deported from the UK back to his home country, which I believe was Ghana. Let's now turn to some potential remedies, solutions to address the problem of unauthorized trading. This one comes from Accenture, an article called Getting Surveillance Right. And I shall read the highlighted point. Ideally, banks should be able to turn post-event investigative data and tools into preventative detection systems that use analytics and real-time reporting to spot deviations from behavioral norms as they occur. Using these methods, banks could also create increasingly sophisticated risk profiles as they attempt to preempt breaches. And in that same article from Accenture, we see a diagram here, major components in the management of rogue trader risk. We can see, for example, here under the heading of processes, confirm trades by end of day, review of all cancelled and modified trades, limits management, obviously quite critical. In terms of technology, there should be complex event processing solutions, correlation across trading platforms. Banks should use sandbox techniques for scenario testing. In terms of analytics, they could be using trends across the core controls, transactional analytics, monitoring of emails, because as has been suggested already, sometimes there's collusion within a bank prior to rogue trading, and if, say, a person is communicating via email or even perhaps on some internal messaging system, this might well turn out to be quite good at anticipating problems. Governance, of course, tone from the top, some of the things I've been talking about, policies and procedures, separation of duties and anti-collusion controls. That kind of bears down on what I just mentioned here. And in terms of people, qualification, skills and training, incentives based on loss avoidance, a fraud-aware culture, and mandatory vacation. Now, this might strike one as odd, but the idea here is that if, let's say, somebody occupies a position where they could engage in unauthorized trading, and that person does not take a holiday, they keep perhaps delaying taking a holiday, then a person that might substitute for them while they were required to take a holiday or vacation could then become aware of some of the practices that have been used with regard to unauthorized activity generally and rogue trading specifically. Internal controls are the first line of defense against unauthorized trading. As already mentioned, there should be a complete segregation of authorization, execution, and settlement activities. We just have to think back to the Jerome Cavil incident, where he had intimate knowledge not only back office systems, but was also handling a very sizable trading book. Written risk limits, automated exception reporting, pre-approved products, counterparty criteria, and close supervision are critical to ensuring that risk control policies are followed. Ongoing monitoring of key controls by middle and back office personnel, and an effective escalation process for calling out rogue behavior provide a key second line of defense. Periodic separate evaluations by qualified internal auditors. This, of course, is what is often called the third line of defense. And clawbacks, deferred payments, and other tools can help to align payments with risk outcomes and actual performance. This goes back to something I have mentioned elsewhere, which is the idea that, let's say, for example, a trader is being paid commission or a bonus on sales performance or trading performance. And let's say now that person does a trade which on the surface or at the beginning appears to be very successful, makes the bank a lot of money, and the person gets paid out a bonus. Perhaps that person then goes on, leaves the bank, and the idea is then more or less impossible to claw back or recover any of the bonus that was paid. And the idea, which is becoming increasingly implemented in banks, is that bonuses, at least in significant part, should consist of some form of deferred compensation or even things like options. Final point that I want to make is that there are ways of insuring against unauthorized or rogue trading. An insurance company, before agreeing to provide cover, will want to conduct due diligence into the firm's risk control and trading limits protocols. And usually, if an insurance company is willing to underwrite at least part of the losses that might arise from rogue trading, they will specify that the existence of rogue trader insurance not be disclosed to anyone on the trading floor. If a claim is made under a policy, the insurer will undertake extensive investigation into the exact circumstances around the loss. But it's also quite important to point out that reputational damage from rogue trading losses could outweigh the mitigation of the financial loss resulting from a payout by the insurer. So I hope very much that you enjoyed that video and found it interesting and useful. If you find this type of material to be of value to you, where I analyze critical ideas and episodes in the world of global finance, could I strongly suggest that you decide to subscribe to this channel. Thanks very much for watching.